Do me a favor. Open your banking app on your phone. Take a look at the balance. You see a number there, right? And because we're rational people, we assume that number represents a physical pile of cash sitting in a vault somewhere with your name tagged on it, just waiting for you to come pick it up. I hate to break it to you, but it doesn't. That number? It's a hallucination. Here is the scary truth. If everyone watching this video right now decided to drive to their local branch and withdraw their cash, the doors would lock, the ATMs would go dark, and the entire global economy would flatline before dinner. This isn't a glitch in the banking software. This is the fundamental operating system of modern finance. We call it fractional reserve banking in the textbooks, but honestly, a better name would be legalized counterfeiting. It is the invisible machine that drives inflation, mandates that we stay in perpetual debt, and aggressively widens the gap between the rich and everyone else. Once you see the gears turning, you'll realize that your money isn't an asset, it's a promise. And as we all know, promises are easily broken. Okay, to understand how we normalize this insanity, we have to rewind to a world before digital ledgers. Let's take a trip to 17th century London. Imagine you're a merchant. You're tired of hauling heavy bags of gold and silver coins across the city. It's slow, it's heavy, and frankly, it's a magnet for thieves. So, you start depositing your bullion with the Goldsmiths. These guys had the only secure safes in town. You give them the gold, and they hand you a paper receipt that says, "I owe the bearer 10 gold coins." Eventually, the merchants had a light bulb moment. They realized they didn't need the heavy metal to do business. They could just pay for goods by handing over the paper receipts. The paper became the money. And this is where the Goldsmiths had their epiphany. They noticed something interesting. On any given day, only a tiny fraction of customers ever came back to reclaim their physical gold. The vault was always full. So, greed took the wheel. The goldsmiths started writing receipts for gold that didn't exist. If they had 1,000 coins, they'd issue 2,000 receipts. They lent these fake receipts out to borrowers, charging interest on nothing. As long as the depositors didn't panic and demand their gold all at once, the goldsmiths got rich on the interest of phantom wealth. Now, this wasn't just a scam, it was the discovery of elastic money, and it was way too powerful for governments to ignore. By the late 1600s, this practice became official. Look at the founding of the Bank of England in 1694. King William III didn't create it out of the goodness of his heart to help the people. He created it because he was broke and needed to fight a war against France. A group of bankers agreed to lend the king £1.2 million in gold, but in return, they were allowed to print banknotes well in excess of that amount to lend to the public. The deal was simple. The government got its war chest, the bankers got a monopoly on money creation, and the taxpayer? Well, the taxpayer got the bill. It is the exact same template used by Washington, London, and Tokyo today. Governments spend money they don't have, and central banks facilitate the creation of credit to cover the gap. In the US, early attempts at this led to the era of free banking, where banks issued their own notes. But time and again, the bluff was called. Crowds would storm the banks demanding gold, only to find empty vaults. But rather than fixing the dishonesty, the state simply built a bigger safety net, the central bank, to act as the ultimate guarantor of the lie. Let's translate this into the mechanics you were likely taught in school. Though, hold on to your hats, because as we'll see in a minute, the classic explanation goes like this. You walk into Bank A and deposit $1,000. The rules say the bank must keep 10% or $100 in the vault. It is free to lend the other $900 to your neighbor. Your neighbor takes that $900 and deposits it into Bank B. Bank B keeps 10%, $90, and lends out $810. This process repeats over and over. By the time the dust settles, that initial $1,000 of real cash has ballooned into $10,000 of broad money circulating in the economy. But here is the dark reality of that math. Only the base $1,000 is real. The other $9,000 is nothing but debt. Every extra dollar in existence is actually someone's liability. If that system sounds fragile to you, brace yourself, because that 10% rule I just described, it's gone. On March 15, 2020, right in the shadow of the pandemic, The Federal Reserve quietly eliminated the reserve requirement ratio. They slashed it to 0. You heard that right. Today, American banks are not legally required to hold a single cent of cash against your deposits. That multiplier model you learned in Economics 101 is dead because the leash has been cut completely. So if reserves are 0, what stops a bank from lending trillions of dollars tomorrow morning? The restraint is no longer about cash in the vault. It's about something called capital adequacy, governed by a rulebook known as the Basel Accords. These rules are drafted by unelected technocrats at the Bank for International Settlements in Switzerland, basically the central bank for central banks. Under Basel III, the limit isn't based on how much cash a bank has. It's based on how much shareholder equity or capital they hold to absorb losses. Think of it as skin in the game. If a bank wants to issue a risky loan, they must hold a certain percentage of their own equity as a buffer. But here is where it gets mind-bending. Banks don't wait for you to deposit money so they can lend it out. In the modern system, banks create the deposit when they make the loan. When you sign a mortgage, the bank isn't moving money from a saver to you. It literally types numbers into a computer, expanding its balance sheet. The money is born at the moment of the signature. Over 90% of the money supply today is this commercial bank money, backed by nothing but the borrower's promise to pay. Now, this system isn't neutral. It produces 3 inevitable, toxic byproducts that affect your life every day. First up, devaluation. When banks print new money faster than the economy creates new goods, your savings are diluted. Inflation isn't a bug in the system. It is a feature of a credit-based currency. Second, the debt trap. Since money is created as debt, there is always more debt owed than money in existence because of interest. It is a mathematical impossibility to pay it all back. The system demands a perpetual stream of new borrowers just to prevent a total collapse. Third, the Cantillon effect. This is just a fancy way of saying the rich get richer. Those close to the money spigot, banks, corporations, the government, get to use the new money before prices rise. You, the wage earner, you get the money last, after inflation has already eaten its value. And when the music stops, the violence of the crash is proportional to the size of the lie. Look at 1929. The roaring 20s were fueled by easy credit and margin loans. When the market turned, everyone rushed for the exit at once. The banks, holding only a fraction of their deposits, imploded. Fast forward to 2008. The asset was different, houses instead of stocks, but the mechanic was identical. Banks had leveraged themselves into the stratosphere, betting on mortgage-backed securities that were essentially garbage. When the payments stopped, the liquidity evaporated. The entire global financial grid almost went dark. And just like in 1694, the solution was not to fix the system, but to print trillions of dollars to patch the hole. And before you think this is just an American story, it's not. The UK, Canada, and Australia have all effectively abandoned reserve requirements in favor of capital rules. Even in emerging giants like China or India, where traditional reserve requirements, RRR, are still used as a throttle to control lending speeds, the ultimate guardrails are the Basel Capital Standards. Whether you are in New York, London, or Shanghai, the limit on money creation is determined by a spreadsheet in Switzerland, not the gold in a vault. Here is the terrifying paradox. The economy is now a hostage to its own debt. If we all became responsible tomorrow, if every household paid off its credit cards and mortgages, the money supply would vanish. The economy would enter a deflationary death spiral. The system needs you to be in debt. It needs you to borrow just to keep the lights on. You are not just the customer, you are the fuel. So what do you do with this information? First, realize that money in the bank is not wealth. It is an unsecured liability. Real wealth is tangible. It is land, gold, energy, productive businesses, things that cannot be printed away by a central banker. Second, understand that inflation is a hidden tax on your time. If you are keeping your life savings in cash, you are slowly bleeding out. The history of finance, from the Goldsmiths to Silicon Valley Bank, is a history of confidence games. The system works only as long as we all agree to pretend the emperor is wearing clothes. But history also tells us that eventually, the crowd stops pretending. Don't wait for the next crisis to learn how the plumbing works. The money in your account is a ghost. Make sure you own something real before the illusion fades. If you want to survive the next chapter of financial history, you need to understand the last one. Subscribe, and I'll help you read the writing on the wall.